So we're going to be looking at a one hell of a CAPM question, especially one related to K. And what do we do to find K? This is a very complicated question in terms of what you may see on your exam, and this is going to be an amazing opportunity for you to prepare for your Introduction to Corporate Finance course. And hopefully I'm able to kind of put you in the right direction. So let's jump right into it. So in this question, we're looking at how we compute our expected return, or our K if you will. So let's look at this question together, and in which we say that a portfolio is invested in a risk-free asset. Okay, that's cool. And a market index. So just like that, I think we should definitely identify a few points. So we have a portfolio. So we definitely know that a portfolio has an expected return. We definitely know that a portfolio has its own risk. All right, so that's pretty cool. Then we know it's invested in the risk-free asset, so RF, and in the market index, so ERM. All right, sorry about that. The portfolio has a 7%, okay, a 7% expected return. And I'm going to zoom out just a little bit for you guys so it's easy to read. And it has a 7% expected return. So we know that ERP is equal to 7%. And it has a risk, a standard deviation of 10%. So in this case, we have equals 10%. The standard deviation of the market index is equal to 22%. Okay, so listen, maybe this may be useful to us afterwards, but we want to know that the market index is of 22%. Okay, so our OM, which is how I call it, even though it's kind of wrong, is 22%. And we know that the risk-free rate is equal to 4%. So we're just trying to define all of the different points that may actually help us for our question. You know, who knows? It may be helpful, it may not be helpful. But your duty is to be able to identify everything and alienate the stuff you don't need and identify the stuff you do need. So in this case, we're asking you, what would be the expected return of a security with a beta of 1.55? Now, in this case, disregard the percentage. So with a beta of 1.55. Now, there's a few key takeaways, and we're going to write them at the top in red. Okay, we're going to zoom in a little bit. And in this question, we're discussing this idea of a portfolio. So we definitely need to look at ERP and how it affects our different elements. Okay. We also know that we've introduced beta. Therefore, it is obvious that we're going to have to use the SML line at one point, okay? So we need to definitely identify, well, what is our SML, okay? Because we want to know what is our K based on our SML, and with that, we need to identify our SML formula. In this case, we know that K is equal to beta times the market risk premium minus the risk-free rate plus RF. I could have written this in a different manner. I could have written this as K is equal to RF plus beta times the market risk premium minus the risk-free rate. They're literally the absolute same thing. So with that, we need to be able to identify, well, how do we get whatever's missing? So in this case, what we'll do is we'll look at our SML formula. I think that's the best step to actually do on an exam, is once again to identify our SML formula and see what we're missing and how we could get to that missing puzzle piece. And we're just going to do that in real time. So in this case, we have RF, right? So we know that K is equal to RF plus something. So in this case, we know that K is equal to 0.04 plus our beta of 1.55 times our market risk premium. So in this case, we want to see, well, do we have our market risk premium in this question? Now, if we go back, we know, we'll highlight in red, we know that we've invested in the market index, okay? And we know that we've been given what's the standard deviation of said market index. But we weren't given anything related to the actual expected return of the market, right? We're given, the return of the portfolio, but we're not given the return of anything else. So in this case, a very important missing part of our SML would be ERM. We do not have that, okay? We do not have that. So that's the missing part to our puzzle. All right. So missing ERM. And that's what we need to be able to find our actual, our expected return of that security. What's our required rate of return for that specific security? And that's exactly what this question is asking us. So what is the expected return of a security with a beta of 1.55? So with that being said, what we need to do now, because we've identified what we know, what we have, and how possibly we could actually get to, our expected rate of return, which is K, we know that we need to get to ERM, okay? We need to get to this second element of our portfolio, okay? And if we go back to what was said in the question, we know, okay? If we go back to our question, we know that we have a portfolio that actually consists of the risk-free rate and the market index, okay? So ERM. So we know that the expected return of that portfolio will be equal to the weighted average, okay, of our risk-free rate and ERM, okay? So that's how we're going to be able to find our ERM, okay? And if this doesn't make total sense to you guys, remember this, and you could definitely watch my other videos. Remember that the expected return of a portfolio under modern portfolio theory, I'll write this down with you. So the expected return of a portfolio, so we're going to call portfolio P, under modern portfolio theory. So under modern portfolio theory will be equal to the weighted average, the sum of the weighted average of its returns. Okay, of its individual securities positions returns. So in this case, that's exactly what we're doing here. The reason why it's only two elements that we're considering is because we know in the top of the question, they're telling us, I'm going to underline this in purple, if you will, or blue, whatever. We're telling us that we have a portfolio that's invested in only two securities, which is the risk-free rate and the market index. Therefore, it makes total sense that we're only looking at our risk-free rate and our market portfolio, okay? So now let's do the same gymnastics. Let's do the same little gymnastic and let's see what we do know and what we don't know. And from there, we're going to be able to assess whether we could conclude our question or we have to look at one other consideration. Now, if you look at your question, you quickly see, and we're going to use green in this case, we quickly see that we know the return of our portfolio and we know the standard deviation of said portfolio, okay? And what we don't know is the weight that's attributed to ERM, and we don't know what's the weight attributed to the risk-free rate. Also, with that being said, we obviously know our risk-free rate. So with that being said, and I'll write it in pink or purple, whatever, we know that we're missing, it seems at least that we're missing, it seems like we're missing two pieces, okay? And that's the weight of our RF. So the weight of our RF, how much of our wealth is placed into the risk-free rate, and what proportion of our wealth is placed into the ERM, the market portfolio, okay? And in order to solve this, you could actually do something super relevant. And I need you guys to remember this, all right? And this happens only if you are investing into a portfolio, especially within the span or the scope of your Comp 308 or finance course. You know that if you're investing in two securities and one of those securities is the risk-free rate, then finding the risk of your portfolio becomes really easy, okay? So let's just start with the idea. When does this promise or this law or this guarantee actually hold, okay? So if and only if you have a portfolio, consisting of two securities or two positions, with 1 being RF, then the risk of the portfolio will be equal to the weight attributed to the risky portfolio, so in this case RM, times its own risk, okay? And if you want to make this more formal, which I definitely see why you would want to, especially in, if you're really studying this, week before the exam, or if you're just, it's not the right time for you to get all the information down, well, you would want to have this formula written down for you. And you've probably seen it within your manual, your lecture notes, or whatever. So we're saying that you could find the weight that you've placed onto the risky asset if you know the portfolio risk and if you know the risk of the risky asset. Okay, so it's going to be equal to this times this. And that's how you find, with this you could find a lot of things, actually, to be completely frank with you. With this, you could derive the risk of the portfolio, you could derive the weight in the risky asset, and you could derive the risk of said risky asset. You could derive a whole lot of stuff. But in this case, all that we need is to identify, all right? So all that we need, if anything, we're gonna do this. All that we need is we need to identify what's our weight, because that's what we're missing here. We know that we have all that other good information. So with this, and just to make it super clear to you guys, if you look at your question once again, you quickly see that we know what's the risk of the market index and we know what's the risk of the portfolio. So all that's missing, as I said, is weight. Sorry about that. Is the weight for our risky asset. And in this case, I have to make this super clear. The risky asset is actually going to be our market index. And I could see why that's, tricky to you, because you would say that, hey, typically the market portfolio should be kind of less risky than others. But anyways, with that being said, we could say now that we have our, we have our risk of our portfolio, which we said was 10%. So we know that we have 10% being equal to the weight into RM times our ORM, so the risk of our market index or market portfolio. In this case, is 22%, such that the weight in the market portfolio and RM, or you could call it whatever you want, is equal to 10/22. And you could also do it with your calculator if you want. You could do 0.1 divided by 0.22. And once again, you still get 10/22. And you could also write that down as 5/11. They all come down to being the same thing. All right, so we have that. And now, because we have this crucial information, this very crucial information, we've uncovered the following. We were able to uncover the following. We're going to be able to figure out, well, what actually is the weight into RF and so forth. And we're going to be, well, we know because of this, by the way. Sorry about that. Because we know this, we obviously know what's the weight into RF. Because the weight into RF will be literally, because things have to add up to 100%. In this case, it would be 1 minus 10/22 would be our weight into RF. Just need to make that brutally clear to you guys. These two things right here are 100% related. Okay, and then with that, we'll find another place. We'll write it in gray, the middle of the page. With that, we're actually able to find our ERM. And if it's, once again, not painfully clear to you, we're trying to figure out, okay, we're trying to figure out our ERM based on the formula that we've attributed to right here, okay? So with that, we're going to be able to calculate that we know that our return of our portfolio, which in this case is equal to, if I'm not mistaken, the return of our portfolio is equal to 7%. So we're going to say that 0.07 is equal to 1 minus 10 over 22, okay, times the risk-free rate, which in this case is 0.04, plus 10 over 22 times the market portfolio. If you want, we can even write it like this. And then when you do the math, you're able to see that ERM is equal to 10.6%. And the reason for which this is the case is because now all that you have to do is solve for ERM. And that's how we got to 10.6%. And I'm not going to spend time doing the algebra. I feel like that's something that you could definitely go through on your own. And it's, it's pretty straightforward. But now that we know this, we're actually able to go back to our starting point. We said that we were missing ERM. But now we know that ERM is actually equal to 10.6%. So if we plug that bad boy into our SML function, we're able to say that, okay, well, K is equal to 0.04 plus 1.55 times 10.6%, okay, minus 4%. And, I used percentages here, but it could have been like this too as a 4%, right? So, I kind of had a brain fart. So in this case, K under CAPM would be equal to 14.23% if you did the math once again. So all that we had to do here was listen, let me be totally real with you. This was a harder question. There's no other way to go about it. You had to go through a bunch of different steps. And not only that, you had to have the clarity of mind or the awareness to identify these different steps. And that's exactly what we did in this question. The first thing that we had to do was go through the question and identify the different elements that were given to us. That was, the return of a portfolio and the risk of that portfolio, as well as the risk-free rate, and as well as beta and other elements. So we used that to figure out, well, okay, because we have beta, we have to use the SML. But if we use the SML, we need the expected return of the market, and we don't have that. But luckily for us, they told us at the very beginning of this question that we have invested into a portfolio that has the risk-free rate and our market index. And with that, we were able to derive what we needed to figure out. We needed to figure out what's the weight into the risk-free rate and what's the weight into the expected return of the market. And like that, we were able to kind of go from a very far point to another. And I hope this was able to help you out. I hope this was able to kind of put you in a powerful position in terms of what you need to master to do well in your Introduction to Finance course. And if you need more information, if you want more references or problems or notes, well, you can definitely go on my website called Ismahelps.com. Of course, you could find more videos on my channel, Ismahelps, but on my website, you actually have access to all of my notes. You have access to all of my pointers and my practice problems like this one, which are going to help you prepare for your exam and are also going to help you prepare for your other finance courses in the future. So you can go to ismahelps.com/comp308 if you're from JMSB, or /intro to finance if you're from any other school all over the world. And that's why I'm doing this. I want to be able to help anybody at literally anywhere at any time. And hopefully this was able to really give you that extra push. And once again, these notes are available in the description below. And listen, I hope this was helpful. Have a good one.